But what we're going to do is we're going to hit secret number 2. So the first one was capital management strategy. The secret number 2 is called the PRP LLC, and everybody knows what that term LLC is, or at least you should know. What this is going to be the ultimate asset management strategy. So this is how our clients can manage assets. So looking at a private retirement plan LLC model, we're going to first start on the exposed side, and typically a client is going to be setting up, if they have any type of investments or business, they're going to have a limited liability company or LLC. Doesn't matter what state. It can be any state, by the way, California, Delaware, Wyoming, whatever the preference is and whatever their typical planning is. But as our attorneys know, but maybe others don't know, a limited liability company is just that, limited liability. What it's meant to do is carve off the risk of the assets in the LLC from the balance sheet of the client, okay, or the member. The problem is some people, and I met attorneys that literally said, oh, why wouldn't I just set up an LLC in California and protect my assets? Well, because you have inside-outside liability. Just because you have real estate or business inside the LLC doesn't mean it can't get sued. So it's maybe protection, and when the clients fund different assets into there, and typically it's real estate that's in there, sometimes there's a myth or there's a fallacy, is the word I would use, that says, oh, I'm protected. So yes, there's a firewall or what they call a corporate veil, but the attorneys that are on this call that I'm looking at their names right now, I guarantee it could bust through that corporate veil. So what we want to look at is, well, how do we truly protect, and the word's going to be exempt, those assets that should somebody want to try to pierce either side of the fence, is have those assets exempt. So what we're going to do is we're going to infuse a LLC and enhance that with a private retirement plan and the private retirement trust that represents that plan. So again, a client's going to hire a TRUST-CFO to set up that plan, and our attorneys to set up the trust, and now that exists. How an LLC can operate is it is actually a diversified model. There are 2 working components. Okay, the first one is member interests, and the second one is a manager. The first thing that we do is we say, well, the member is the owner, and that's different from the manager. And so what it will have is we'll have, if a LLC is existing, we'll assign the member interests to the private retirement plan. So now those member interests aren't owned by the client, they're owned by the exempt trust. And if you're setting up a new, or we partner up with our power attorneys, and the attorneys are setting up a new LLC because maybe it's needed for real estate or investment management or even an active business, then the attorney that would issue that operating agreement would then issue the operating member interest in the form of the private retirement plan right off the bat. There's some tricks to that, and again, we'll escort you with that. But from a high level, what we're talking about is we're talking about member interests that may be exposed to litigation and the assets, to now exempting those assets. So now the private retirement plan becomes the exempt member, the owner. But the exempt member is just somebody that receives the distributions, when they're distributed. They're not the manager. So when we separate those roles, and they're clear in the operating agreement, and there's provisions that are specific to an LLC, a private retirement plan LLC, that are different than you might find in a wealth counsel document, or even better yet, on LegalZoom online, the template documents. You need to make sure that these provisions are in there and that these roles are very specific. As the manager goes, what you're going to find is the client doesn't like to lose control. They're going to say, well, I'm managing, Derek in our office has a doctor that has 59 real estate rental properties, and we're not going to manage those. We can't manage those. And he has his staff manage them. So what he's going to do is he's going to have a committee that manages his portfolio of real estate in the LLC, and they take in their income and expenses from the real estate, and they also pay out, they take in the income and the rents from the real estate, but they pay the expenses, and they operate the LLC, financials. And he can even take salary. So he can say, listen, I'm providing services rendered. I have a value here, and as the manager, as a non-owner, I want to get a salary. So that becomes a gateway or a spigot by which we can turn on and have some of those funds from the LLC provide a life, income or lifestyle benefit to the client. They also take those monies in the LLC and they typically reinvest, like the doctor. I think it was like 2 or 3 years ago, he had like 25 properties. Now he's more than doubled. He's a bit of a machine. So we want him to manage it and his team to manage that. But the manager does not own the asset. The manager only manages the asset. So if you want to sue the manager, you're going to sue the manager for manager duties. You're not going to sue them for the assets because the assets are owned by the private retirement plan trust, which is an exempt member. Again, the distinction between exemption is that I have many discharge notices that the courts say, well, we have a claimant and the plaintiff wants to sue this plan or trust, please send us a document, and we send it to them, and then the judge sends back, says, I can't file a suit against this because the plan's exempt. And then the client, or the attacker then has to go through the machinations and wherewithal and decide if they want to spend money to try to look at that plan. Typically, the barbarians just stop at the gates. So again, what we're doing is we're providing an enhanced level of protection and manageability for the client. At the end of the day, what happens is you do accumulate corpus in that LLC, and the LLC will make distributions, and that's when the funds do get moved over, and whether they're end of the year or they're accumulated and spent and then paid off later years, those can be paid then into the private retirement plan. And that's great. Why? Because at the end of the day, the private retirement plan has actually committed to providing a certain benefit, a retirement benefit to the client, the beneficiary, the primary beneficiary of the plan. Until such time, remember, all funds in the plan are exempt. All distributions coming from the plan, if properly administrated by TRUST-CFO, would be exempt, and even death benefits of the passing of the LLC member interest to spouse or heirs or for the legacy are going to be exempt. So that becomes a very potent model. We're going to add one other thread to this, which again, this is for the ultimate retirement. Maybe that's 10 years off. Maybe the client's 55 and our plan is to distribute it to 65. In the meantime, those distributions are accumulating. And so what we want to look at is how do we mitigate the taxes on those distributions as they're coming in? We're going to show you secret number 3, which is the PRP accelerator. And the uniqueness is the LLC is now an active business. It's managing assets, and that can even be passive assets. And it can then say, well, we want to take some of those reserves and we want to make them pre-tax and set them aside for a rainy day. And that becomes a tax benefit. Because it's an LLC, what happens is those tax benefits that we might create then pass through and flow through down to the client. And so again, we're able to create a flow that is allowing our client to make sure that they're managing and allow us to optimize in terms of asset management and capitalize on all the various benefits at the appropriate time. That's what the LLC model does. Again, it looks a little complex, but if you deconstruct it, you have it, all the working components. And these are all the items, by the way, that TRUST-CFO, the T's and the I's that we trace and we evaluate at each point, and then we document. And that's the value for us as an administrator. Okay, so that's the LLC model. And we're not going to run through any cash flows on that. I'm going to do that in the accelerator. But basically, in a recap, secret number 2 is, as I stole this from Verdon, he has his high-sit trust, is have your cake and eat it true. So I'm not violating his trademark, Jeff. But it is a cake and eat it too scenario in terms of asset risk management. Captures and banks profits and distributions for maximum growth, optimizing values, and maximizing our benefits. And then lastly, what it's really going to do, it's going to keep our admin simple. I have a client that has 40 apartment complexes and 40 LLCs. They're not going to hire TRUST-CFO to administrate that inside the private retirement plan and take in and collect all the rents and pay all their bills. We're not built for that. That's not our job. The manager needs to be doing that. So what that has actually done is it's simplified the model and allow us just to administrate the final financials of the LLC that are now owned in a private retirement plan and keep the tracking simple and keep the cost down for our clients. If we get too complex, we're gonna have to raise the price, and it's gonna start thwarting the value to benefit proposition or the ratio. So again, this has been a great way. We're not out to gouge clients, we're out to maximize our value. So we're able to get things done. I have a client that has $65 million in LLC member interest for nursing care facilities, and we charge him $7,500 per year to administrate. And he literally said, that's a deal. He put out his hand and shook my hand saying that's a great deal. So that's what we're trying to accomplish here with the PRP LLC.